What's going on? Welcome to Gamma Trader, and today we're gonna take a little intro into stock options. So I'm just going to assume that you already know what a stock share is. So here we have the S&P 500. So just a quick intro into it. Let's say you bought one share of the S&P 500 this morning at the open, 6:30, and it rallied up all the way up to 292. So one share you would have made 2% at $292. So 2% of 292 is like at the most like $4 or $5. So you wouldn't have really made that much since it's a very small move, and today's move was actually it was a pretty big move, so I wouldn't be impressed if you lost interest on making trying to make money in the stock market. You would have to actually bought million or invest millions of dollars to see a decent size gain. So another option you have is stock options. So right here we have the options chain. We can see this is called the options chain. So the options chain is divided by date. So we have the chain that's 14th of August, 16th August 16th, August 19th, August 21st, August 23rd, August 26th, and it goes all the way down, and we can see that we have December 17th, 2021, 2020s, 2019s. So that's the chain itself. So how would you choose which one, or how do I choose to buy and sell? Like, what chain do I choose? How do I know which one is gonna give me the most profit? Well, I, as a day trader, I'm looking for volatility. So volatility is the option chain that will move the most. That is the higher risk, higher the gain. So if we try to buy one at December, if we try to buy a contract down at December 17, 2021, if we see if this was within market hours, we would see that the price is not even ticking. So like there is no potential for me to make money right here, especially because the contract is $29 right here on the close. If it's closed into the money, it's $29 for contract. So that's 10 times 100. I would need a lot of big capital to make no money. So what I do is I always try to buy the one that's ready to expire. So for example, today traded August 14th. Today is August 13th. Well, actually, no. Today traded August 13th. This is tomorrow's option chain. So I'm gonna be trading tomorrow. I'm gonna be trading this chain. Yeah, this is the chain I'm gonna be trading tomorrow, I think. And so what happens is the closer you get to expiration date, the the faster they move. So the August 14th option chain will move faster than the 16, and the 16 will move faster than the 19, and essentially the 14th August 14th will move faster than any other option chain. So okay, so now we are in the option chain. So how do we know which strike price to buy? So we have here the strike price. We can see that the strike price we have rows of one row is 279.50, 280, 281, 282, 282.50, 283. Okay, so now how do I know which one to buy? We have really big range of options on which one to buy or sell. We have a whole lot of options. So the way that I buy is depending. If I want to make money going up, I'm going to buy calls. This is when I expect the stock to go up. In this case, would be the S&P 500 index. So the calls I would buy this side, and if I want to make money when it's going down, For example, right here, if I wanted to make money as it's coming down, I would buy this side, the puts. So when the stock is going down, the puts increase in value. So for example, if I got in right here at 7:34 a.m. around $293 with 53 cents, and this was the current strike price, 293, and I would get in at $1.50. When as it's going down, decreasing in value, this would tick up. So it would go 115, 120, 125, 130, 145, 150, essentially getting out on the bid, around 120s or 130s. So the same rule applies for the calls. When I want to make money, when the stock is going up and I want to make money as it's going up, I would buy, anywhere. Well, actually, I buy lower, but just to keep it simple, I would buy around $1, and as the stock is going up, it would uptick to 110, 120, 130, 150, and then I would get out on the bid, on this side. So as the stock is going up, the puts are going down, and as the stock is going down, the calls are going down. So that's how it works. They both go up and down based on the price action of the current ticker symbol, which is the S&P 500. Okay, so how do I know which strike price to move? Well, again, I want to buy the strike price with the most volatility. So, for example, let's say I would want to, get in at. I always try to buy the strike price that's around 20 cents. So, for example, if I wanted to get in a position right now with a put, expecting the stock to go down, I would buy it at 22 cents. So, whenever you buy or whenever I buy a strike price, my order gets filled on the ask. So we can see we have the ask, and we have the ask is at 22 cents. At the same time, if I want to get out as soon as I got in, for example, let's say we have the bid at 20. If I got in at 22 and I would want to get out right now as soon as I got in, well, when I send my order, the price I get filled at is 20 cents. So I just lost 20 cents. I would have to wait for the stock to tick up, and then the bid would uptick as well, 20, 21, 22, 23, 24, 25, 26 cents. And that's how it works. Whenever I buy the number that's right at the ask. So it would be either 22, and depending on the strike price, on which row, and the column right here, the ask. This is the column ask, and this is the bid ask. So I get in on the ask and get out on the bid. So same thing on the call side. If so the calls right here around 20 cents. So we can see that we have the ask at 30 and the bid at 27. If I wanted to get in expecting the stock to go up, I'd get around 30 cents, a strike price of 295, get in at 30. If I wanted to get out as soon as I got in, I would get filled at 27 cents. So I'd be losing money if that's what had happened, if I had gotten out as soon as I got in. So I would have to wait for the stock to uptick or go up, and to make money if the and then the bid would start upticking as well as the ask. I think I said the inverse right here. The puts, it upticks as the stock is going down. I think I said the reverse of that. So yeah, the bid or the puts go up as the stock is going down. So as the stock is going down, we can see that the ask upticks when the price is going down. So we have 20, 21, 22, 23. I'm going to show you an example in a few minutes just to for clarification. So why not? Okay, so now why not buy puts? Why not buy the strike price that's at a dollar? Why not buy it at $6? Why not buy it at $5, 5 cents, or why not buy it at 3 cents? Okay, so the most volatile stock price or strike price is at 20 cents. As the strike price goes up, volatility decreases. So, for example, if I wanted to get in at this strike price 293, and I got in at 115, and then the stock made a 20-cent move, to the downside. Yeah, I almost made the same mistake again. Okay, so if it makes a move to the downside, 20 cents to the downside, this strike price might move 10%. At the same time, this strike price at 289, with the price at 20 cents, that's the most volatile. So if I buy it at $1.50, I have a probability of making 10 cents. At the same time, the 289 strike price, I have a probability of making 20%. So this is where it's the most volatile. So it's as the strike price, um, or the price of the strike increases, volatility decreases. So, which means as the higher price I buy it, the lower gains I'm going to make. So why not buy it? If that's true, then why not buy it at 9 cents? Well, the problem with buying it at 9 cents is that instead of waiting for a 20-cent move on the stock, you would have to wait for a 50-cent move, which is very rare. Since I am only in positions, for 10, 15 minutes at the most. And also the other thing is that I don't know if it's gonna move 50 cents. I know for a fact that price action on the S&P 500 moves, or there's breakouts of at least 20 cents. So I know that if I make money, I'm gonna make money here. But as we go down, we have to wait for a bigger move for the price to move at all. So, for example, the price move for right here, they are more susceptible to price action, which means they move a lot more than these strike prices right here at 3 or 4 cents. So, for example, today, this morning at the open at 287.70, uh, you probably wouldn't have seen, or I probably wouldn't have seen these prices, 3, 4, 5 cents, make a move up until 291, and that's a really big move. Then it would have probably had, instead of 3 cents, it would have been like 5, 6 cents. So we would have to wait for a bigger move to actually make money down at the lower strike prices. Same thing goes for the calls. Uh, as the stock price goes up, the calls go up. But again, if we buy down here at 3 cents, we would have to wait for a big move like this one to see them uptick, 3 or 4 cents. And at the same time, if we buy the strike price up here around $3, $4, we would have to wait for an even bigger move to make 2 or 3%. But if we buy at 20 cents, it's just the right strike price to make some money with a 20-cent move, which happens more often than not. So that's the reason I always try to buy around 20 cents, 30 cents a week. Like, for example, today, I think I only traded the calls and the puts around. The calls, I think I did around 30 cents, and the puts around 20 cents, because you can see that the we have 20 cents, and then we have 30 cents over here. So we don't have actually 20 cents strike price. We don't have a strike price with 20-cent value. We only have at 30-cent value. So today's puts I traded at with a strike price valued at 20 cents, and that's how it is. So I'm gonna go on demand and do a just so that you can see how it actually moves. Let me see how far back I can go. Let me see. 9th, Friday the 9th. Okay. Oh, that is Friday the 9th. Okay. Oh, no, it's not. All right. I think it was. Okay. So, for example, let's try and get in. Let's just do an example. Well, 6:38 a.m. So this is not how I take my trades. I'm just going to show how price action actually moves. So from 6:38 to 6:50. All right, just give it a minute. I'm just gonna fast forward it so it won't take that long. Okay, so here we plan on making money as the stock price is going down. So we can see that you can see the flashes. That's how you know they're ticking. So, for example, right here we have the strike price at 290 and 50 cents. That's valued at 21 cents. So we're just gonna watch the ask and the bid with a strike price of 290 and 50 cents, and see how that's not even moving. Oh yeah, let's wait for it to catch up. So this is not how I take my trading. This is just to show you how the options chain reacts to price movement. Okay, there we go. Well, I really don't like that. Let me just delete this. Oh, that's better. Okay. So at this time and at this price at 299, 292, 90ish, 293, the strike price of the strike price, the value of the strike price of 290 and 50 cents is at 22 cents. So for example, if I wanted to get in, I send my order and my price is 290 or 22 cents, right? So let's just keep an eye on it for 10-15 minutes and see, what happens. So I was in at, supposedly 22, I think it was. It flashed real quick. So I'm just gonna just keep an eye on it so that you can see how it reacts to your price action. Okay, so you can see that the bid now is at 25 cents. So that right there, I'm already in the money, and that was a like a 87. That's barely a that's like a 20-cent move. So, and it's already at 31. Just gonna keep, just to be sure that more than clear. So this the index, the S&P 500, is still selling off. A little bit of a bounce. Those selling orders. So right now, if I wanted to get out right now, I'd be selling at 30 cents. So I got in at 22, and I would sell at 30 cents. So, that right there, I would have already been in the money or making money. So right now we're looking at about 30% profit. If I had gotten in at 22, getting out at 28ish, 30 cents. So right now it ticked up to 33 cents. The bid. So remember, when we get in at the number that's on the ask, and when we get out on the number that's on the bid. So we got in at 22 on the ask, and if we get out, for example, right now, we'd be getting out at 33 cents. So that's how I would make money as the stock is going down. Now let me show you how the calls react to price action when it's going up. Let me just take a quick look at it right here. 652 to 656, 652, previous day. Hmm. That says 62, 651. Oh, there it is. Okay. So, for example, if I wanted to make money as the stock is going up, I would get in right here at 25 cents. Like I said, I always try to buy in the 20s. So the ask would be 25. I would be in at 25. And you see that the price is currently going up. I hate these bubbles. Turn them off. There we go. That's even better. Okay. All right, so got in at 25. I think that was the price that was, make believe price entry. So we can see that this 293 strike price is already upticking as the stock is going up. At the same time, the puts are down ticking. So gutting at 25. Right now the bid to get out is 29, 30. So getting out right now at 35 on the bid on the strike price of 293. That would have been like a 35% profit. Um, buying as this to make money as the stock went up. So that's just to show how how the options chain reacts to price action. So don't let the numbers scare you off. It's really simple and easy to move or to read, better said. So like I say, I always try to buy around 20 cents on the calls or 20 or 30 cents max. Same thing on the puts, 20 or 30 cents max. Okay, so that was a little intro and to the options. Fairly simple, and same rule applies every day that I trade the stock market. So that's how you make big gains. Trading a very slow moving index. So like I say, the S&P 500 made a pretty big move compared to what it actually makes move daily. But as far as the options go, they move a lot more. So here, let me say another thing. So for example, today the stock market made a 2% move, but let me see how many points that actually is. So that way, 7, 88, 89. So it moved almost $5 today on this big rip. So the difference is so it moved $5, but we're not gonna go in like today. For the past couple weeks, the gamma has been very low, so we're actually we're having to hold a little longer than we're usually used to. So, for example, when the gamma is 50% or less, we have to hold a little longer than we're used to. Usually, for example, let's see here, we can see the 289 strike price. The ask price is at 22 cents. Today's gamma was um, around 11 cents. So when the gamma is below 50%, so 11 cents is less than, right around 50%. When the gamma is at 50% of the price, we have to hold even longer. But when the gamma is at anywhere between 75 or higher percent of the price, so for example, if the ask price was 22 cents and the gamma would have been around 18, 19 cents, then we don't have to hold as long to make the same amount of money. For example, those two trades that I took right now, they netted around 30%. I didn't even look at the gamma. But the gamma would have been or must have been anywhere around 70, 80%. So this the gamma related to the price, you don't even have to worry about that. I actually imply that on my trades on a daily basis. That's something like that. You shouldn't worry about it. It's just actually the only thing that really matters. I actually have to have something. All right, I'll just move the delta. All right, so okay, one more thing that I want to break down before I leave. So usually you're gonna hear day traders, or not day traders, but options traders talk about the delta, the gamma, the theta, which is the value and the price or the value of the strike prices, how they change, how they move, how they react, their volatility, and everything. But me as a day trader, I'm really only interested in the gamma. The theta, the vega, the delta are really useless to me. I don't really, use them or need them at all. So I don't think any day trader actually even needs them, for my trading style. So just wanted to point that out. Don't be scared about the gamma or the delta, theta, the vega, or even the gamma. Like I say, I imply that the gamma percentage into my trade, so you don't have to. And the only thing you have to know is the bid and the ask. And like I said, the only thing you have to know is that I buy around 20 cents, 20, 27 cents. When I want to go short on the puts, or when I want to make money that if the stock is going down, buy the puts around 20, 27 cents. And if I want to make money when the stock is going up, I buy the calls around 27 cents. We can see we don't have the 20 cents strike price value. And whenever I get into the position, I get filled on the ask. So I buy the number that's on the ask. For example, that would be the 30 cents, and the puts would be the ask, the 27 cents. That's to get in, and to get it out, it would be the bid number. So in this case, would be 25 cents, and the calls would be the bid number would be 27. These other numbers are really not of any interest or should be of any interest to uh, my followers. All right, so that was all. This is Gamma Trader, and I'll see you at another lesson to see when I can break down another something else. Next time I'll probably break down the technical uh, or the technical studies. Uh, you know. All right. So see you in another video.